Hey everybody, welcome back to another YouTube channel. So in today's video, I wanted to talk about a different options trading strategy that helps people make money on red days, like this day right here where SPY basically had a loss and there was a red day. So if you're new to the channel, be sure to leave a like on this video and subscribe to the channel to not miss any other options trading videos that I make or other videos that I make about personal finance and investing. And let's just get right into this. So in the past, I've talked about call debit spreads, and I've made videos about that on my channel. So if you're interested in that, go check those out. I basically talk about how I got like an 83% return in a week using a call debit spread. So if you're interested in that, go check that out. But basically, a call debit spread works where you're essentially making money when a stock price increases in value, and a call credit spread works where you're making money when a stock price decreases in value. So I'm going to open up the SPY options, and it's going to bring up this options trading calendar right here. And so the way that you would open up a call debit spread, as I've talked about in the past, is you would essentially buy a call right here, and then you would sell the call right above it. And you can see right here, Robinhood will tell you exactly what you created, which is a call debit spread. Keep in mind that this works on any brokerage, not just Robinhood, but for this demonstration, I'm going to be using Robinhood's brokerage interface as an example. So this is a call debit spread, and how this works is basically this right here shows you your total cost for going into the contract. And then if I click continue and review offer, this right here will tell you how many shares or how many contracts you're opening, each contract dealing with 100 shares. This is a limit price, and whatever this number is, you just multiply this by 100, since we're dealing with 100 shares, and that's how much it would cost. So this would just cost $28, since it's 28 cents per share. So the max cost would be $28. And then the max profit, if I go back a little bit here, you can see that right here the max profit would be $72. And the way the max profit is calculated is you just take the difference between the strike prices of the contract. So for this, it would be 455 minus 454, which is 100. And then that you just subtract your total cost from that number. So 100 minus 28, which would be 72. So this would be the max profit. So I'd basically be risking $28 for the chance to make $72 on top of my 28. So the full return would be $100, but I'd be risking my 28 and then bringing in an extra 72 profit on top of that. And the way a call debit spread makes money is if the share price by expiration date on September 7th is higher than the strike price for the call that I sold, which is this call right here. It's 455. Then I would be able to make the max profit of $72. So this is a bullish strategy. You would want the share price to go up in value so that it would be above the strike price for the call option that you sold, which is how you would make the max profit. And the way that I call credit spread works is it's pretty much the exact opposite. So instead of buying a call right here and then selling the call right above it, I would buy the call up here, and then I would sell the call right underneath it, and that would open up a call credit spread. How a call credit spread works is essentially it's a little bit different than a call debit spread. In a call debit spread, this right here would usually show your total cost, but for a call credit spread, this is showing your total credit. So this is how much money you would make. And then how much money you would risk is the difference between the share prices. So it would be 100 in this case. So you'd be risking 100, as you can see right here. If I click continue, review order, it'll say collateral $100, and then my minimum credit, which is my max return. So I'd be risking $100 to make whatever the minimum credit is. So that's basically how the interface is different between call credit spreads and call debit spreads. For call debit spreads, this would show you your max cost, and then your collateral, or not your collateral, this would show you instead of it being your collateral, this would show your max cost, and then your profit would be the difference between the $100 minus whatever it is that you were spending. And the way that a call credit spread works is essentially the way call debit spreads work, where you would make money if the share price is above the strike price for the call option that you sold. For call credit spreads, you make money if the share price is below the call option that you sold. So this is the call option that I sold in this case, and this is the one that I bought. So on expiration date of September 7th, if the share price for the S&P 500 ETF SPY is below 454, then I will make my max profit of $28. And the difference between a call, one of the other differences between a call debit spread and a call credit spread is that for a call debit spread, the cost is what's spent when the spread is opened, and then as the share price increases, the profit, the total profit that's available, starts being made. But for a call credit spread, this minimum credit is given to you the moment you open up the trade. And so instead of having to make the profit the way you would in a call debit spread, for a call credit spread, the full profit is given to you, and then depending on the direction that the share price goes in, it slowly chips away at the full credit that's given to you by chipping away at your underlining collateral of $100. So let's say, for example, I were to open up this call credit spread right here, and I would spend $100 in collateral, and my minimum credit would be $28 right here. So essentially what would happen is the share price, let's say, since this is a bearish strategy, I'm hoping that the share price goes down, but let's say that it starts going up and it crosses this 454 line right here, this strike price. For every 1 penny, for every cent that it crosses past this strike price right here of 454, so let's say it went to 454 and 2 cents. For every cent that it goes above this strike price, that's $2, or that's $1 per cent that I would lose on my underlining collateral. So since I'm spending $100, a difference between 455 and 454, if this went to like 454.02, for example, then that would mean that instead of being returned the full $100 of collateral on expiration date, if on expiration date this is at 454.02, then I would only be returned $98, because 455 minus 454.02 is equal to 98 instead of 100. And then obviously if the share price goes above the 454, then I just lose all of my collateral, but I would still get to keep my minimum credit. So really all you're risking when you open up a call credit spread is the difference between the minimum credit and the collateral. So since it's 128 right here, 100 minus 28 is 72. So I would really only be risking $72 in order to make $28, and that's a pretty good return. And obviously you don't have to do this on this particular expiration date of September 7th. You can do this for pretty much any expiration date, all the way to like December 15th of 2023. And so basically, if I just opened up, like, say I opened up, let me close this out. If I opened up this call credit spread here, if I just bought this one and then sold the one right underneath it, this is basically me saying that I think that come like 2023, December 2023, that the share price would be below the strike price of the call option that I sold. And in this situation, this is pretty highly unlikely because American markets tend to overall go up over a long period of time. So in this case, it would probably make more sense to open up a call debit spread in this case, to say, like, let's say I bought this and then sold the call right above it and opened up a call debit spread. This would be me saying the share price of the S&P 500 ETF is going to be above the strike price for the call option that I sold. And so this is basically me saying that I think that come December 2023, that I think that the share price of SPY is going to be above 465, and that's pretty reasonable. And if that were the case, obviously I'd be spending 425 right here for a max profit of 75. So whatever that is, I mean, we can Google what that return would be right now. Just opening up the calculator, and then we look at the max profit, which is 75. So 75 divided by the max loss, or our total cost, which is 425, and that would be a 17.6% return by 2023. And then obviously it doesn't have to be this far out. You can do one that's closer to the expiration date, say like the earliest one, like September 7th. And if I were to open up, say, a call credit spread right here, this would be a total credit of 28, and then my total collateral of 100, which is a 28% return just about. So a 28% return by September 7th, that's just in a couple of days. If the share price is below the strike price for the call option that I sold, that's a pretty good deal. Keep in mind that the total S&P 500 usually returns on average about 10% per year. So making like 28% in literally just a couple of days, wherever the expiration date is that you set for the spread that you open, that's a pretty good deal in my book. So that's just how you would open up a call credit spread. And that's really how it differs from the call debit spread. A call debit spread is a bullish strategy. So you think that the share price for the ETF is going to go up, whereas a call credit spread, the exact opposite, is a bearish strategy. So if you open it, that means that you think that the share price for whatever stock or ETF you're using is going to decrease before the expiration date for the spread that you open up. So that's basically it. Comment down below what you guys think of this strategy, if you guys are using it, or what other strategies you guys are using. I'd love to know. Thanks for watching, and thanks for making it to the end of the video.